want to bring in Brad Neuman. He's the director of market strategy at Alger. And Brad, talk to us just about, want to get your reaction to this number and why you see this setup as attractive for housing heading into the new year.
Well, the new home sales data that you cited looks soft. We think that structurally it's a good market and that America's short maybe 2 million homes. So we need to construct new homes to house people. And on the remodeling side, existing home sales is pretty weak. It's well below normal levels. So, Alger, we're growth investors. We're looking for companies that are gaining market share. And if we can find them in industries that are cyclically down on their luck and could recover, then we can get a really quality growth stock at a cheaper price, which is nice. And so, there's several stocks that fit the bill there. For example, Trex, which makes composite decking, which is lower total cost of ownership over the long term than wood and more environmentally friendly. Trex is the leader in that market. They've got about 55% market share, and each year that composite decking takes 100 to 200 basis points a share. So we see it as a great growth company that is in a cyclically challenged industry that will ultimately come back.
What's the model or the rubric that you're utilizing to suss out the winners within sort of flailing sectors? Because that strikes me as the thing that's really hard and why you guys get paid the big bucks.
Yeah, well, we've been doing it for 60 years, so we've always been growth investors. We look for companies that have a strong value proposition. So I just mentioned, for example, with Trex, that their product really resonates with buyers because it has a low cost of ownership. So a company has to have a good value proposition for its product or service. It has to be gaining share, has to have a strong management team, competitive advantage. And if it has all those things, then the fundamentals will take care of itself and we think provide strong returns for investors.
But as you take a step back and looking just beyond housing and at the market overall, lots of questions just about valuation, concern, I should say, about valuation, some concentration, obviously, within the market. I'm curious how you see a Trump 2.0 administration affecting those trades down the line.
So valuations are high and sentiment is pretty lofty. If you look at consumer confidence in stocks, it's last month it was the highest it's ever been reported in terms of people looking for gains in stocks over the next 12 months. But that said, we don't think investing in policy or investing for short term is how we look at things. We look at investing in companies that are going to gain, like I said, market share over the long term. And so, if you went back to Trump 1.0 and you want to invest in policies, you'd probably be in value-oriented, domestically focused companies. And those companies did do well from kind of the election in 2016 through March 2017, and the value rally fizzled out. And if you looked at the 4-year period from Trump 1.0 election to the following election, value stocks, Russell 3000 value was up about 16%, and the Russell 3000 growth more than doubled. So we think innovation won out in Trump 1.0, and we think the same thing will happen in Trump 2.0.
I wonder, though, if we could start to get a little bit of a feedback loop. There's this idea that the market is going to be a check on Trump, but when he has an announcement like the tariffs announcement overnight here and the market continues to be moving to the upside today, then is he even more emboldened to issue more tariffs, and then it just kind of continues from there. What does the lack of a market reaction tell you about what the market's feedback loop could look like under Trump 2.0?
I agree with you. The market will probably serve as somewhat of a governor here. So what the tariffs that he were alluding to were actually maybe even below market expectations. 10% China is kind of low. I mean, yes, if you put all those tariffs into effect, you'd have 50 to 75 basis points of inflation. And if they all went into effect, that would be worse for interest rates than I think some people are expecting. But not all of those should go into effect. And I think the market was braced for kind of a scarier announcement. So I think that's one of the reasons why the market took it in stride.